The dollar is not going to collapse next week. It is not going to collapse next month. And anyone telling you that the end of the dollar system is a matter of quarters rather than years is either confused about the mechanism or optimizing for your anxiety rather than your understanding. But here is what is true. The dollar's collapse, defined not as the overnight disappearance of a currency but as the progressive loss of its structural primacy, the gradual stripping away of the privileges and the dependencies that have kept it at the center of global finance for 80 years, began before the war in Ukraine. It began before the pandemic. It began, if you are being precise about the starting conditions, somewhere in the decade following 2008, when the Federal Reserve made decisions that were necessary to prevent an immediate catastrophe, but that set in motion long-cycle consequences that are only now becoming visible to the broader market. The war did not cause what you are watching. The war accelerated it. That distinction is not semantic. It is the most important analytical distinction in understanding what comes next, how fast it comes, and what you are supposed to do with that knowledge. In the last 3 years, the following has occurred. The United States froze $300 billion in Russian sovereign reserves, a decision that demonstrated to every sovereign holder of dollar assets on Earth that their reserves were subject to political seizure under the right conditions. The dollar's share of global foreign exchange reserves fell to its lowest level in recorded modern history. Gold was purchased by central banks at a pace not seen since the world was on the gold standard. The BRICS coalition doubled its membership. Saudi Arabia completed oil trades in Chinese yuan, and the United States interest payments on its own debt crossed $1 trillion annually for the first time in history, a figure that now exceeds what the country spends on its entire military. Most people are looking at these data points and asking which one caused the problem. The answer is none of them. They are all symptoms of the same underlying condition, a condition that was decades in the making, that the war compressed into a visible crisis window, and that is now operating with a momentum that policy adjustments cannot reverse. Stay with me for the next 25 minutes because I am going to give you 3 things that almost no serious financial analysis is connecting with sufficient clarity or sufficient honesty. First, the actual origin of the dollar's structural vulnerability. Not the war, not the pandemic, not any single policy error, but the accumulated consequence of a specific set of decisions made over 4 decades that were each rational in isolation and collectively catastrophic. Second, what war does to a reserve currency, not in the dramatic sense of battlefield outcomes, but in the precise institutional sense of how geopolitical rupture accelerates monetary transitions that were already underway, and why the speed of that acceleration matters more than most people realize. Third, what the post-dollar world actually looks like, not the fantasy of an overnight replacement, not the dismissal that nothing will change, but the honest, historically grounded picture of what happens during the long middle period of a reserve currency transition, and which assets and positioning strategies have historically survived that transition intact. I have spent a career studying these cycles at the level where monetary history, geopolitical structure, and institutional behavior intersect. The pattern before us is not unprecedented. It is, in fact, one of the most studied transitions in modern economic history. The names and the numbers are different. The mechanism is recognizable to anyone who has watched it operate before. To understand the truth about the dollar's condition, you have to begin not with the war, not with the pandemic, not with 2008, but with a decision made in the early 1970s that was presented to the public as a technical adjustment and was, in reality, one of the most consequential monetary acts of the 20th century. In August 1971, Richard Nixon ended the convertibility of the dollar into gold. The formal name for what he did was closing the gold window. What he was actually doing was removing the constraint, the only external constraint, on American fiscal and monetary expansion. Before that moment, the dollar's credibility as a reserve currency rested on a specific promise: 1 ounce of gold for $35, redeemable by any foreign central bank that chose to exercise that right. After that moment, the dollar's credibility rested on nothing external. It rested on trust, on institutional behavior, on the expectation that the United States would manage its currency with the discipline that the reserve currency function requires. For a period, a surprisingly long period, sustained by the petrodollar architecture that emerged from the 1974 Saudi-American arrangement and reinforced by the Cold War's structural demand for American security guarantees, that trust was sufficient. The world needed dollars to buy oil. The world needed American military protection against Soviet expansion. The world parked its surplus wealth in treasury bonds because there was no credible alternative, and because the United States, most of the time, behaved with enough fiscal and monetary discipline to justify the arrangement. Here is what matters. The discipline that sustained that trust began eroding in a specific and traceable way, beginning in the early 1980s. The Reagan deficits, the progressive normalization of peacetime fiscal expansion, the 1990s interlude of relative fiscal responsibility, the only genuine such interlude in the post-Nixon era, followed by the return of deficit spending after 2001, accelerated after 2008, and then amplified to a scale that would have been considered dystopian fiction as recently as 2019 during the pandemic response. Between 2020 and 2021, the United States added more to its national debt in 24 months than it had accumulated in its entire history from 1776 through approximately 1980. The Federal Reserve expanded its balance sheet by nearly $4 trillion in that same period. The money supply, as measured by M2, grew by approximately 40% in 2 years. These are not normal numbers. They have no peacetime precedent in American history. And they were the proximate cause of the inflation that followed, an inflation that the Fed initially dismissed, then belatedly fought with the most aggressive rate cycle in 4 decades, then found itself trapped by because the debt load it had helped create made sustained high rates fiscally untenable. This is the part most people miss. The dollar's vulnerability was not created by the war in Ukraine. It was not created by any single decision or any single administration. It was created by the accumulated consequence of repeatedly choosing short-term economic comfort over the long-term fiscal discipline that the reserve currency function requires. It was created by treating the exorbitant privilege, the ability to borrow in your own currency at suppressed rates because the world structurally needs that currency, as a permanent endowment rather than a contingent trust. Every reserve currency in modern history has been lost through some version of this process. Spain's financial primacy in the 16th century, eroded by the inflationary consequences of New World silver that the empire spent faster than it could sterilize. The Dutch guilder, in the 18th century, undermined by the financial overextension of the Dutch East India Company and the wars that followed. Sterling, the 19th century's reserve currency, fatally weakened by the fiscal consequences of 2 world wars in 30 years. Each of them was lost not in a moment but through a process, a long accumulation of structural overextension that eventually reached a threshold beyond which restoration became impossible without a generational reset. The United States reached its own version of that threshold somewhere in the gap between the pandemic response and the inflation crisis that followed. The war did not create the threshold. The war revealed it, and then it accelerated the consequences. Now let us be precise about what war does to a reserve currency, because this mechanism is specific and it operates through channels that are not well understood in popular financial commentary. War, when it involves a major reserve currency issuer, or its immediate strategic sphere, does 2 things simultaneously to the monetary system. It increases the fiscal demands on the issuing nation, more spending, more borrowing, more debt at exactly the moment when the debt load is already elevated. And it forces every other nation watching to make explicit decisions about risk that they could previously defer. The second effect is the more important one for understanding the current moment. Before the freezing of Russian reserves in March 2022, the question of dollar risk at the sovereign level was theoretical for most nations. The conversation existed in academic papers, in diplomatic discussions, in the quiet deliberations of central bank reserve committees, but the theoretical possibility that dollar assets could be seized, that a nation's accumulated savings held in the dollar system could be weaponized against it by American foreign policy, had never been operationalized at the scale of $300 billion against a major economy. When it was operationalized, the theoretical became empirical. The risk that had been discussed in abstract terms became a demonstrated, documented reality. And the institutional response to demonstrated reality is fundamentally different from the institutional response to theoretical possibility. Write this down. Before March 2022, a finance minister in Beijing or New Delhi or Riyadh could look at the academic literature on dollar reserve risk and say, this is an interesting theoretical concern, but the political relationship is stable enough that the risk remains hypothetical. After March 2022, that same finance minister was looking at a live case study. The political relationship between Russia and the United States had appeared reasonably stable through multiple prior crises. It deteriorated, and then $300 billion was gone. The rational institutional response to that case study is not to immediately dump all dollar reserves. That would be destabilizing and self-defeating. The rational response is to begin quietly and persistently reducing exposure, diversifying the reserve portfolio, building alternative relationships, establishing alternative settlement pathways, and increasing the proportion of reserve assets that carry no counterparty and no political risk. Which is to say, increasing the proportion of gold. This is exactly what happened. The pace of central bank gold buying in 2022 and 2023 broke records that had stood for 50 years. The nations buying were disproportionately those with either existing geopolitical tensions with the United States, or existing memories of being on the wrong side of American financial power, or strategic relationships with nations in those categories. The war did not change where they were going. It changed how fast they moved there. Let me be precise about the timeline implications of that acceleration. Monetary transitions that play out over decades in normal conditions can be compressed into years when a sufficiently dramatic, catalytic event provides both the motivation to move faster and the political cover to do so openly. The war in Ukraine provided both. It motivated faster reserve diversification by demonstrating that the theoretical risk was real. And it provided political cover by making the diversification legible as a risk management response rather than an anti-American posture, a meaningful distinction for nations that need to manage their American relationships while simultaneously managing their exposure to American financial power. The acceleration matters because it changes the time window available for positioning. A transition that might have taken 20 years in the absence of the war may now take 10 or 8 or less. The structural forces were already in motion. The war compressed the timeline. And the compressing of the timeline is precisely why this moment, right now, while the transition is still in its early stages, while the optionality still exists, is the moment that matters most for anyone thinking seriously about wealth preservation across the next decade. Now watch what happens next, because the third thread is where the picture becomes most practically important. If this kind of structural analysis, the mechanism beneath the headlines, the long cycle beneath the daily noise, is what you have been searching for, subscribe now. We will continue building this framework systematically, and the perspective you are developing here will compound in value as the transition accelerates. The most dangerous misconception about reserve currency transitions is also the most common one. It is the idea that a reserve currency either holds its position or collapses. That the dollar will either remain the unchallenged center of global finance or it will be replaced overnight by something else with nothing in between. History does not support this binary. History supports something considerably more complex, considerably more gradual, and in many ways considerably more difficult to navigate, precisely because it does not provide the clarity of a sudden event. It provides the ambiguity of a long transition. Consider what the sterling transition actually looked like for those living through it. The British pound was the world's dominant reserve currency through the end of the 19th century. It began its structural decline in the aftermath of the First World War, as Britain's fiscal position deteriorated, and the United States emerged as the world's creditor rather than its debtor. That decline was not visible as a single dramatic event. It was visible as a series of pressures, devaluations, exchange controls, the progressive withdrawal of sterling from international reserve portfolios, spread across more than 30 years. People living through the 1920s, the 1930s, the 1940s experienced specific episodes of crisis and partial resolution, never knowing whether the pound's decline was temporary or terminal. It was only in hindsight, from the perspective of Bretton Woods in 1944, that the transition could be seen as a single, coherent story. We are inside the equivalent period for the dollar. Not at the beginning, the seeds were planted decades ago. Not at the end, the dollar will remain the dominant settlement currency for global trade for years to come. We are in the long middle, the period of visible stress, declining trust, sovereign diversification, and the slow accumulation of structural alternatives that precedes the formal recognition of a changed order. This is the part most people miss. The long middle is not a comfortable period for holders of dollar-denominated wealth. It is not an apocalypse, but it is a period of sustained, directional purchasing power erosion, inflation that runs persistently above the historical norm, interest rates that cannot be raised high enough to fully control that inflation without breaking the fiscal arithmetic, and the gradual repricing of every asset that was valued on the assumption that the dollar system would remain intact indefinitely. Here is what matters. In every prior reserve currency transition, the assets that preserved wealth across the long middle were not the ones that were easiest to hold, or most familiar, or most highly marketed. They were the assets that existed outside the system undergoing transition. Physical commodities, real productive assets, and most consistently, most durably, across every monetary transition in recorded history, gold. Not because gold is perfect, not because gold generates income or pays dividends or compounds at the rate of a well-run business, but because gold exists outside the network of institutional promises that a reserve currency represents, because it has no counterparty, because its value is not contingent on any government's fiscal discipline, any central bank's credibility, or any geopolitical relationship remaining functional. Because it is the one asset that has been recognized as monetary wealth across every civilization, every century, and every prior monetary transition that history has recorded. The sovereign buyers who have been accumulating gold at a record pace since 2022 did not arrive at that decision through a simple inflation calculation. They arrived at it through exactly the analysis I have been laying out, a structural analysis of where the dollar system is in its long cycle trajectory, what the war accelerated, and what the long middle of a reserve currency transition historically requires in terms of portfolio construction. Let me be precise about the current positioning of those sovereign buyers. Central bank gold holdings, as a percentage of total global central bank reserves, have been rising from a multi-decade low. They remain well below the levels that prevailed during the Bretton Woods era and before. The direction of movement is toward historical norms, not away from them, which means the structural buying pressure is not at a peak. It is in a sustained trend that has multiple years of momentum behind it, and based on the institutional logic driving it, multiple years of continuation ahead. Let us now bring the three threads into their final synthesis, because the picture they create together is more important than any single element viewed in isolation. The truth about the dollar's condition is that its structural vulnerability is not the product of any crisis, any war, any administration, or any single policy failure. It is the product of 4 decades of accumulated fiscal overextension, of repeatedly choosing to treat the reserve currency privilege as a permanent entitlement rather than a contingent trust, of expanding debt and money supply at rates that were each individually justifiable and collectively unsustainable, of making the dollar system so deeply leveraged against its own credibility that any significant shock would find it without the institutional buffer it needed to absorb that shock cleanly. The war in Ukraine was that shock. Or rather, it was the shock that made the existing structural condition visible, that forced the question of dollar reserve risk from the theoretical into the empirical, that provided both the motivation and the political cover for sovereign institutions to accelerate diversification decisions they had been contemplating for years, and that compressed a transition timeline in ways that are now operating with their own momentum, independent of any future geopolitical development. The post-dollar world is starting to see R, to be precise about it, is not a world without the dollar. It is a world in which the dollar is one significant currency among several rather than the singular anchor of global finance. It is a world in which oil is sometimes priced in yuan, sometimes in dollars, sometimes in bilateral clearing arrangements. It is a world in which sovereign reserve portfolios carry substantially more gold and substantially less dollar-denominated paper than they do today. It is a world in which the exorbitant privilege, the ability to borrow cheaply in your own currency because the world structurally needs that currency, has been reduced rather than eliminated. And the reduction of that privilege in a country carrying $30+ trillion in debt has fiscal consequences that compound in a direction that the current political system has demonstrated no capacity to address. What unites all three threads is the same force I keep returning to, because it is the only force that actually explains the full picture, the progressive, structural, accelerating erosion of the institutional trust that gives the dollar its power, not its collapse, its erosion. And erosion, unlike collapse, does not announce itself. It accumulates, it compounds, and by the time it is undeniable to the consensus, the positioning opportunity has largely passed. There is a question that I have been asked in various forms throughout the years I have spent studying these long cycles. The question is, if this is so clear, why don't more people see it? The answer is always the same. They do see it. The central banks buying gold see it. The sovereign wealth funds reducing dollar exposure see it. The finance ministries quietly establishing yuan settlement pathways see it. The institutional capital moving, slowly and deliberately, away from dollar-denominated paper and toward hard assets sees it. What most retail investors do not see is not the direction of the force, it is the timeline. They expect transitions at the speed of market events, the speed of 2008, when everything changed in weeks. Reserve currency transitions move at the speed of sovereign decisions, the speed of decades, compressed by crises, but still measured in years. That timeline is both reassuring and demanding. Reassuring because there is still time to think clearly rather than react. Demanding because the clarity is required now, while the transition is still early enough for positioning to matter, and not after it has become the consensus view of every financial commentator who will eventually explain why it was inevitable all along. The truth about the dollar's condition is not comfortable. It is not a simple story with clean villains and obvious heroes. It is the story of an extraordinary institution that overextended itself incrementally over 4 decades, was confronted by a war that exposed that overextension to every sovereign on earth simultaneously, and is now navigating the consequences in real time with the tools it has, in a fiscal and monetary environment that has no clean resolution. Gold, rising steadily and methodically through levels that once seemed extraordinary, is not predicting a collapse. It is pricing a transition. A long, slow, sovereign, irreversible transition from the world that was built at Bretton Woods in 1944 to whatever comes after it. That transition has a direction, it has a logic, and it has a timeline that the war just made considerably shorter than it was before. The truth about the dollar is not what collapses it. It is what was always required to sustain it, and what we chose, repeatedly and collectively, not to provide. That choice was made across decades. The consequences are unfolding now, and the only question that remains is not whether you understand what is happening, but whether you have decided clearly, deliberately, without panic but without complacency, what to do with that understanding.